You've heard it a million times, right? It's probably the most famous piece of advice in all of investing. But let's be honest, how many people actually pull it off? Today, we are going to break down how you can actually, truly master the art of buying low and selling high.
There it is. 4 simple words. It's the entire game in a nutshell, isn't it? It's what everyone is trying to do. But the incredible simplicity of the phrase is exactly what makes it so incredibly difficult to do in real life.
And that really is the million-dollar question. If the instructions are that obvious, why do so many of us end up doing the complete opposite? Getting caught up in the hype and buying high, only to panic and sell low. Well, that's the big puzzle we're going to piece together today.
So here's our game plan. First, we're going to dig into why this whole strategy even works in the first place. Then we'll face the beast, the emotional battle that messes all of us up. After that, we get practical. We're going to look at a real tool for timing, a way to read the overall mood of the market, and finally, the secret to actually sticking with your plan when everyone else is freaking out. Okay, so first things first. The entire reason buy low, sell high is a viable strategy is because the market has a fundamental, predictable flaw. It isn't some perfectly rational machine. The market has a habit, a tendency to get way too excited and way too scared, pushing prices far above or far below what they're actually worth.
And what's driving these wild swings? Well, it's us. It's people. It's something called the herd instinct. When an investment looks hot, everyone piles in, all at once, creating a bubble. And when things get scary, everyone sprints for the exit, causing a crash. It's this collective human emotion that creates those massive peaks and valleys, which, if you're smart, you can learn to use to your advantage.
Right, so this huge market overreaction isn't happening because of some complex algorithm. It's happening because of us. And that gets us to the absolute heart of the problem. The main battle here isn't against the market, it's the battle inside your own head. Our brains are literally hardwired to follow the herd. It's a survival thing. But when it comes to investing, that same instinct can be an absolute disaster.
This is the tug of war that goes on in every investor's mind. It's like you've got 2 voices in your head. The rational one is saying, okay, the rule is to buy when everyone is panicking. But the emotional voice is just screaming, are you crazy? Get out now! Sell! And on the flip side, when a stock is soaring, your rational brain says, hey, maybe it's time to take some profit. But your emotional brain shouts, no way, this is going to the moon, buy more. See? Our feelings are almost always pushing us to do the exact wrong thing at the exact wrong time.
So if we know we can't trust our feelings, what can we trust? The numbers. We need a tool that's completely objective, something that just cuts through all that emotional chaos and gives us a clear signal, no drama involved.
And a fantastic tool for this is the moving average. Here's a way to think about it. A normal stock chart is all jagged and jumpy, right? All those little ups and downs are like bumps in the road. A moving average basically smooths out that road so you can see the real direction it's heading. It's based only on past prices, 0 emotion, 0 guesswork.
Now, using it is actually pretty straightforward. It's called a crossover strategy. You just watch 2 of these smoothed out lines on a chart, a short-term one, usually 50 days, and a long-term one, like 200 days. When the short-term line crosses up and over the long-term one, that's your buy signal. It shows positive momentum is building. And when it crosses down below the long-term one, that's your signal to sell. Simple, mechanical, and totally emotion-proof.
Okay, so that tool is amazing for a single stock. But what about the big picture? To really nail buy low, sell high, we have to zoom out and figure out what the whole market is feeling.
Because if you look at the market over decades, you see this pattern repeat over and over again. It swings like a giant pendulum back and forth between 2 powerful emotions, extreme fear and extreme greed. And here's the key. These swings aren't random. They actually follow a pretty predictable cycle. And that emotional pendulum is tied directly to the economy. Think about it. When the economy is in a recession, fear is absolutely everywhere. The headlines are awful. People are pessimistic. That is the moment of maximum fear. And it is without a doubt the best time to buy. Now flip that. The economy is booming. Everyone's feeling rich. And it seems like the good times will never end. That's greed. That's maximum optimism. And it's the perfect time to start selling.
So how do you track this stuff? You don't need a crystal ball. You just need to pay attention. You can follow news about the business cycle and keep an eye on official reports, like the Consumer Confidence Survey. These things give you a real data-driven peek into whether fear or greed is running the show.
All right, so now we have our tools, we've got a way to analyze the stock, and a way to read the market's mood. We're all set, right? Well, here comes the hardest part. Actually using the tools, especially when every fiber of your being is telling you not to.
Let's just think back for a second. In 1999, during the dot-com bubble, the idea of selling a tech stock sounded absolutely insane. The feeling was, this is a new era. The internet changes everything. Then jump to 2008. The market is crashing. The financial system feels like it's about to collapse. The idea of buying anything felt just as crazy. In both cases, the overwhelming public feeling was incredibly powerful and completely wrong. Those moments of extreme emotion, that's where the real opportunity is.
And this really gets to the core of it all. Being a successful investor isn't about having some magic ability to predict the future. It's about having a system, a method, and then having the discipline to ignore all the noise and just stick to it, especially when it feels uncomfortable.
So let's wrap this all up. Buy low, sell high works because markets and people tend to overreact. It's hard because our own brains are wired to join that overreaction. But we have tools, right? We've got moving averages for timing specific stocks, and we can watch the business cycle to tell when the whole market is either too fearful or too greedy. But in the end, the real secret, the magic ingredient, is just the discipline to trust your system when the crowd is shouting at you to do the opposite.
And that's really the question I want to leave you with. You know, the tools we've talked about, they're not that complicated. The real challenge isn't the method, it's you. It's your own discipline. When everyone you know is panicking and selling everything, can you be the one who calmly clicks buy? And when they're all euphoric and bragging about their gains, can you be the one who quietly takes some profits off the table? How you answer that, that's the key to mastering this whole game.